What's up everybody, it's Pablo and welcome back to the channel. Today we're talking about something that's crucial for anyone looking to build long-term wealth, investing in the stock market. But not just any stocks. We're diving deep into the 10 telltale signs that a stock is not only affordable but also primed for potential growth in 2025 and beyond. Now, finding these hidden gems in the market can feel like searching for a needle in a haystack, right? Trust me, I get it. That's why I'm excited to share some seriously valuable insights from my friend Pablo Espinal's blog. He's got a knack for breaking down complex financial concepts into actionable strategies, and today, we're tapping into his expertise to help you make smarter investment decisions. So, whether you're a seasoned investor or just starting, stick around because these 10 signs could be the game changer you've been waiting for. Let's jump right in. First up, we're tackling the price-to-earnings ratio, or PE ratio for short. The PE ratio tells you how much investors pay for each dollar of a company's earnings. Think of it like buying a small business. A low PE ratio could signal an undervalued stock. But it could also mean investors are wary of the company's future. Don't invest based solely on the PE ratio. Now, I know what you're thinking, Pablo, how low is too low when it comes to the PE ratio? And that's a fantastic question. There's no magic number here, but generally speaking, a PE ratio below the industry average could indicate an undervalued stock. But remember, context is key. You've got to consider the company's industry, growth prospects, and overall market conditions. For example, a tech company with a PE ratio of 30 might be considered undervalued if its competitors are trading at 50 or 60 times earnings. On the other hand, a utility company with a PE ratio of 10 might actually be overvalued if its peers are trading at 5 or 6 times earnings. The bottom line is this: the PE ratio is a fantastic starting point for your research, but it's just one piece of the puzzle. Don't get too hung up on finding the absolute lowest PE ratio. Instead, focus on understanding what's driving that ratio and whether it aligns with the company's long-term growth potential. Next up, let's talk dividends. Now, who doesn't love a little extra cash in their pocket? That's essentially what a dividend is, a way for companies to share their profits with their shareholders. And the dividend yield? Well, that's just a fancy way of measuring how much cash you're getting back for every dollar you invest. Think of it like owning a rental property. The rent you collect is like the dividend, and the dividend yield is like your rental yield. The higher, the better, right? So, if a company has a dividend yield of 4%, that means for every $100 you invest, you'll receive $4 in dividends each year. Not bad, right? Now here's the thing. Not all companies pay dividends. Some companies, especially those in growth mode, prefer to reinvest their profits back into the business, and that's perfectly fine. But if you're looking for a steady stream of passive income, then dividend-paying stocks can be a great addition to your portfolio. Now you might be wondering, how does a high dividend yield make a stock more affordable? Well, it's all about the cash flow, baby. When a company pays out a consistent dividend, it's essentially putting money back in your pocket, which you can then use to buy more shares, reinvest in other assets, or simply cover your living expenses. Think of it like this. You're buying a rental property, and the rental income helps offset your mortgage payments. Similarly, a high dividend yield can help offset the cost of owning the stock, making it more affordable in the long run. But here's the catch. Just like with the PE ratio, a high dividend yield isn't always a guaranteed sign of a good investment. Sometimes a super high dividend yield can be a red flag, signaling that the company might be facing some financial troubles. Always do your research and make sure the company has a solid track record of paying dividends and that its business model is sustainable in the long run. Alright, let's talk about the price-to-book ratio, or PB ratio. It compares a company's market value to its book value. Book value is the net worth if a company liquidates its assets and pays off debts. The PB ratio shows how much you're paying for each dollar of book value. A low PB ratio might indicate an undervalued stock. Now, Analyzing the PB ratio effectively isn't just about looking at the number in isolation. You gotta dig deeper and understand the company's assets. Are they primarily tangible assets like real estate or machinery, or are they intangible assets like patents and brand recognition? This can make a big difference in your interpretation of the PB ratio. A company with a lot of tangible assets might have a lower PB ratio because those assets are easier to value. Conversely, a company heavily reliant on intangible assets might have a higher PB ratio, reflecting the potential of those assets to generate future earnings. Remember, the PB ratio is just one piece of the puzzle. It's not a magic bullet, but it's a valuable tool to have in your arsenal when you're evaluating stock affordability. By considering it alongside other financial metrics and a thorough understanding of the company's business model, you can make more informed investment decisions. So, next time you're researching a potential investment, don't just glance over the PB ratio. Take the time to understand what it means, compare it to industry benchmarks, and see how it fits into the bigger picture of the company's financial health. Alright, let's talk about the debt-to-equity ratio, or DE ratio, which is number 4 on our list. Now this one is all about understanding how much debt a company is using to finance its assets relative to the amount of money its shareholders have invested. Think of it like this: it's a measure of a company's financial leverage. A high DE ratio means the company has been relying heavily on borrowing to fund its operations, which can be risky. Imagine someone maxing out multiple credit cards to fund their lifestyle. It might work for a while, but it's not sustainable in the long run. On the other hand, a low DE ratio generally indicates that a company is more financially stable and less risky. They're not overly reliant on debt and are in a better position to weather economic downturns. It's like someone living within their means and saving for a rainy day. They're more likely to be financially secure. Ideally, you want to look for companies with a DE ratio below 1, but remember, the ideal ratio can vary depending on the industry. Now here's the thing about the DE ratio. It's not a one-size-fits-all metric. You have to consider the industry. Certain industries, like utilities or telecommunications, tend to have higher DE ratios because they require significant upfront investments in infrastructure. Think about it. Building power plants or setting up nationwide communication networks requires massive capital expenditure. So don't freak out if you see a higher DE ratio for companies in these sectors. It's not necessarily a red flag, but it's essential to understand why. On the flip side, industries like technology or consumer goods often have lower DE ratios. They might not need as much debt to fuel their growth, especially if they have strong cash flows from their operations. Remember, context is key when analyzing the DE ratio. Always compare a company's DE ratio to its industry peers and its historical DE ratio to get a comprehensive understanding of its financial health. Alright, let's dive into number 5 on our list of stock affordability indicators: earnings growth. This one's pretty straightforward. It's all about how much a company's profits are increasing over time. As investors, we love to see consistent earnings growth because it indicates that a company is on track to generate more value for its shareholders. Think of it like this. You invest in a business, you want to see that business making more money year after year, right? That's what earnings growth is all about. It's a sign of a healthy and expanding company, and it can drive stock prices higher over the long term. Now, when analyzing earnings growth, it's not just about looking at the absolute numbers. We also want to see consistency. One good year followed by a couple of bad years isn't ideal. We're looking for companies that can demonstrate a track record of steady and sustainable earnings growth. Remember, past performance is not indicative of future results, but a history of consistent earnings growth can be a strong indicator of a company's potential to continue growing in the future. So, how do we evaluate earnings growth in the context of stock affordability? Well, a company with a high rate of earnings growth might be able to justify a higher stock price. Think about it. If a company is consistently growing its profits at a rapid pace, investors are likely willing to pay a premium for its stock. However, it's crucial to consider the sustainability of that growth. Is it driven by organic growth in the company's core business, or is it fueled by one-time factors or accounting gimmicks? We want to see sustainable growth that's built on a solid foundation. Additionally, comparing a company's earnings growth to its industry peers is essential. A company might look like it's growing rapidly, but if its competitors are growing even faster, it might not be as attractive an investment. Remember, earnings growth is a crucial factor to consider when evaluating stock affordability. By analyzing its consistency, sustainability, and comparing it to industry benchmarks, you can gain valuable insights into a company's potential for future growth. Market capitalization, or market cap, represents the total value of a company's outstanding shares. Calculate it by multiplying the stock price by the total number of shares. Market cap helps us understand a company's size and potential growth. Smaller companies or small cap stocks often have more room to grow. Large cap stocks are more stable but less volatile. Higher risk can mean higher rewards, so research and explore. Now you might be thinking, Pablo, how does market cap actually tell me if a stock is affordable? Well, it's not just about the raw number, but what that number tells us about the company's potential. A smaller market cap often means the stock is priced lower relative to its potential for growth. Think of it like buying a house below market value. You're getting more for your money, just like you might find a stock that's undervalued based on its market cap. But, just like with real estate, you need to do your due diligence. Look at the company's financials, its management team, its competitive landscape. Does it have a solid product or service? Is it in a growing industry? These factors, combined with a smaller market cap, could signal a potentially affordable and undervalued stock. Remember, market cap is just one piece of the puzzle. It's not a guarantee of success, but it can be a valuable tool in your investing toolkit. Use it wisely, and you'll be well on your way to finding those hidden gems in the stock market. Alright, let's talk about analyst ratings. Now I know what you're thinking, Pablo, should I really be listening to these Wall Street guys? And you know what? You're right to be skeptical. These analysts aren't always right, but their ratings can still provide valuable insights. Think of analysts like movie critics. They watch a ton of movies, they have a deep understanding of the industry, and they can offer informed opinions. But just like you wouldn't blindly trust a movie critic's taste, you shouldn't blindly follow an analyst's rating. So, what do these ratings actually mean? Well, analysts typically use a system of buy, hold, or sell ratings. A buy rating means they believe the stock price is likely to go up, a hold rating means they expect it to stay relatively flat, and a sell rating means they think it's going to go down. Now, the important thing to remember is that these are just opinions, educated guesses based on their research and analysis. They're not guarantees, and they can be wrong. But by understanding what these ratings mean and how they're determined, you can start to use them to your advantage. So, how do you use analyst ratings effectively without blindly following them? Well, it's all about context and doing your own research. Don't just look at the rating itself, but dig deeper into the analyst's reasoning. What are their justifications for their rating? What are their price targets? Do they have a strong track record of accurate predictions? By understanding the why behind the rating, you can make a more informed decision. Also, it's important to consider the source. Different analysts have different biases, different areas of expertise, and different levels of credibility. A buy rating from a reputable analyst with a proven track record is obviously going to carry more weight than a sell rating from someone who's consistently wrong. Remember, analyst ratings are just one piece of the puzzle. They can be a helpful tool, but they shouldn't be the sole basis for your investment decisions. Do your own research, understand the company, and use analyst ratings as a supplement to your own analysis. Alright, let's talk about insider buying. This is one of my favorite indicators because it gives us a glimpse into what company insiders, the people who know the business inside and out, are doing with their own money. Now, insider buying refers to when executives, directors, or other high-level employees purchase shares of their own company's stock on the open market. This is important because these insiders have access to information that the public doesn't, like upcoming earnings reports, new product launches, or potential partnerships. So, when insiders are buying up their own company's stock, it often signals that they're confident in the company's future prospects. They're putting their money where their mouth is, and that's a very bullish sign. Of course, insider buying isn't a foolproof indicator. There could be other reasons why insiders are buying, like tax planning or portfolio diversification. But in general, it's a positive signal when you see significant insider buying activity. Now, you can't just look at any insider purchase and assume it's a buy signal. You need to look for significant buying activity to really get excited. So what does significant look like? Well, it's not just about the dollar amount, although that's important too. You also want to look at the number of insiders buying, the timing of their purchases, and their track record. For example, if you see multiple executives buying large chunks of stock shortly after a significant dip in the stock price, that could be a very strong buy signal. It suggests that they believe the dip is overblown and that the stock is undervalued. On the other hand, if you see a single insider making a small purchase, it might not be anything to get too excited about. It could just be routine portfolio management. Remember, insider buying is a powerful tool, but it's not a guarantee. Use it in conjunction with other indicators and your own research to make informed investment decisions. Let's talk about industry trends. When an industry rises, it's like catching a giant wave. Think about the e-commerce boom. Amazon rode that wave to incredible growth. Identify industries poised for long-term expansion. Look for disruptive technologies and changing behaviors. These are catalysts for massive growth. Electric vehicles are a huge trend. Companies in this space are booming. Invest in high-growth industries. Position yourself for significant rewards. But pick the right companies. Find well-managed, financially sound companies. Do your research and understand the potential. Don't just follow the crowd. Align with your goals and risk tolerance. Negative industry trends can drag down your investments. Be aware of industries facing headwinds like declining demand or increased competition. Traditional retail struggles as consumers shift online. Investing in declining industries is risky. Short-term opportunities exist, but long-term outlooks are often bleak. Stay informed about industry news and technological advancements. Understand changes in consumer behavior. These insights help predict industry trajectories. The stock market is forward-looking. Investors anticipate what's next. Weak industries are often already priced into stocks. Stay ahead of trends to make informed decisions. Knowledge is power in investing. Now let's zoom out and look at the bigger picture, the overall economy. A strong economy creates a favorable environment for businesses to thrive and stock prices to climb. Key indicators like GDP growth, unemployment rates, and inflation provide valuable insights. These indicators influence your investment decisions. By keeping an eye on these indicators, you can adjust your investment strategy accordingly. Interest rates and inflation are critical economic indicators. The Federal Reserve sets interest rates, impacting the economy and stock market. Low rates boost investment, high rates combat inflation but slow growth. Inflation erodes investment value, prompting rate hikes. Stay informed about the Fed's actions and their impact on your portfolio. So there you have it, folks. We've covered 10 key signs to look for when trying to determine if a stock is affordable and worth investing in. From analyzing financial ratios like the PE ratio and debt-to-equity ratio, to understanding industry trends and economic indicators, we've explored a range of factors that can help you make more informed investment decisions. Remember, investing in the stock market involves inherent risks, and there are no guarantees of profits. It's crucial to do your own research, diversify your portfolio, and invest for the long term. If you're looking for more in-depth information on these topics, be sure to check out my blog, where I regularly share my insights and analysis on all things personal finance and investing. Thank you so much for watching. If you found this video helpful, please give it a thumbs up, leave a comment down below, and subscribe to my channel for more videos like this. Until next time, remember to invest wisely and build that wealth.